So yesterday, the Houthis, who, by the way, are terrorists, and I'm not, I guess I haven't done a good job of caveating enough of this stuff. Sometimes when I talk about it, I just jump right into the economics. But uh, Houthis are a sort of radical Islamist group in Yemen who have been involved in an intermittent civil war there for years, if not decades, as well as a brutal war, uh, again, intermittently with Saudi Arabia and some of their neighbors for years, and who attacked the oil facilities at Abqaiq in Saudi Arabia in 2019. Um, and they are closely affiliated with Iran's IRGC, the sort of militant wing, sort of the SS equivalent for the Iranian regime. Um, and they're funded, or at least historically were at least partially funded and supplied by Iran's sort of radical militant wing, which is directly associated with the ruling group in Iran. And so they threatened yesterday to close the Strait of Bab el-Mandab, and they actually said it was closed to Saudi oil tankers and to tankers carrying Saudi oil. And this morning, um, there it shows up now on the satellite feeds, and I don't have one of those open right this second, but I was just looking at it. Um, Two oil tankers that were headed towards the Bab el-Mandab Strait that gets you essentially from the Red Sea out to the Indian Ocean, which would let you to get to Asia sort of expeditiously. They turned around and headed towards the Suez Canal. And there is a bypass at Suez where you don't necessarily need your tanker to go through. You can sort of load up oil onto a pipe, and that takes it sort of through that north part of Egypt. But there's limited flow there, and the analysis I saw was you could get something like 2 to 2.5 million barrels a day of oil through that to the north, versus recently it looks like as much as 7 million barrels a day of oil and products were flowing to the south through Bab el-Mandab, mostly Saudi oil that had been going west through Yanbu and then south, but then also some oil and refined products coming down, I guess, from Russia and some other sources. And so it is meaningful that it's shut. It's also meaningful. Apparently, one of the two tanker owners I read was Uniper, which is a Chinese tanker company and oil company. And so it's pretty noteworthy that a Chinese tanker with Saudi oil would turn around and not potentially subject themselves to an attack by the Houthis. So why does this matter? This matters because the Strait of Hormuz is also closed, and so and the price of oil is still only here. I'm going to pull up this. I like looking at the CNBC one. It's slightly delayed, but I just I like their stuff. So they, oil is only up 2.4% to $85 and change WTI. And I mean, this is remarkable because back when the strait was closed and people were worried about it staying closed, but um, Bab el-Mandab and the Red Sea essentially were open, oil hit a peak WTI of around, at least during trading hours, of around $113 a barrel. And then it actually got pretty close to that again in the middle of May. It got to 108 or something, 109. And so that is remarkable because here we are with a much, much more severe, potentially evolving situation for oil, and we are just not seeing the price move yet. And so I think that to the extent that this continues, which is a big if, and we'll see, and there's people have pointed out that the Houthis have not yet there's Somali attacks, which were also reportedly IRGC linked, on tankers and cargo ships recently off of the coast of, what was it, off of the coast of Yemen, but sort of Somalia, sort of down on the other side there. Um, but there have not yet been reported Houthi attacks on tankers or other ships going through Bab el-Mandab. And yet it's noteworthy that a couple of these tankers are headed the other direction. To the extent that Bab el-Mandab truly is closed, you could see, in my view, all-time high oil prices on an inflation-adjusted basis. It would basically take my ridiculous "make oil $100 again" hat, which is sort of this ironic, Trump has done basically everything he can to suppress oil prices while also trying to implement various other policies. And so there's sort of this irony in the it's the "Make America Great Again" hat, but from an oil perspective. Um, but I think maybe a different hat is going to be in order shortly. You can get it on the Bison Printify thing if you want. I don't really make any money from those. I just donate all my net proceeds to. So far, I've just been donating them to the zoo, but it's fun to see them in the wild. A few folks have posted pictures on social media of them wearing these 250 WTI hats or some of these others, and it's just honestly just a fun way to market this Bison Insights. So I think that's, and on one hand, it's sort of funny to talk about the hats and whatever. On the other hand, this could be catastrophic from a global economic perspective. So for the world's sake, 250 WTI, at least right now from this, would be catastrophic. $100 WTI, I think, is pretty fantastic. I think refined products, a little too expensive here. Refining margins are all-time highs. A lot of different factors for that, some of which I think may reverse shortly, but we'll see. But we've seen that the market has really absorbed close to $150 oil net effectively through current oil prices plus very high refining margins. If those margins come down a lot, there's room to absorb $100 plus oil quite easily without impacting demand any more than it's already been impacted. So $100 oil, I think, would be quite good. It'd be great for the U.S. economy. It would help drive additional drilling demand and very capital intensive investment, very labor intensive. It would help from the U.S. labor market has been weakening, softening. It would be helpful for that. It'd be helpful for real estate. There's a lot of demand in oil active areas or in proximity to oil active areas for housing. And frankly, if you're gonna have high rates, which we have right now, at least relative to recent levels, you really want higher oil. I know it might sound weird, but it's actually quite good for the U.S. economy. Ben Bernanke did a study on this and published it, I think, in 2016. I updated it with my team at my fund, Bison Interests. We published something in 2024 about how higher oil prices are good for the U.S. economy. We relied on some of the work from Ben Bernanke, but also just there's a reality, which is that if you're a net exporter of something, you want the price to be higher, not lower, generally speaking, on average over time. And so the U.S. is a net exporter of hydrocarbons, of oil and oil-related products. It's actually technically a net importer of crude oil to a small degree, but a huge exporter of natural gas liquids, which price off of oil to some extent, as well as of LNG, which actually prices off of oil in many markets globally. And so the U.S. is a beneficiary substantially of higher oil prices, despite what politicians on both sides will tell you. It's one of the sort of indications that maybe there's more of a uniparty in the U.S., where you have people with very different sort of economic theories agreeing on something that's factually untrue. That a Fed chairman that I'm not sure anyone really likes at this point published on how it was not true, and everyone just sort of ignored it, and no one's really refreshed their views on these things. And I will be out there saying it, and hopefully others will sort of figure this out. But higher oil prices, moderately higher oil prices, are very good for the U.S. economy. This move up should be good. There were lots of calls for a deep recession in March when oil prices rose. They were wrong, and U.S. economic activity actually sped up. Industrial activity sped up. The rigs started to rise. You saw big bumps in employment in oil, essentially provinces, oil areas where there was incremental activity. We saw a huge bump up in workover activity. and we're seeing a sustained move higher in oil drilling activity. So this is very good from a U.S. economic perspective. It is fantastic for oil and gas uh, drilling services providers and other oil field services providers. I own a bunch of those. I've written about them extensively here on Bison Insights. I think there's some of them that are still just wildly cheap. Some are down materially from where they were a few months ago, even though their own and the overall rig counts are up in the US, in Canada, elsewhere. And so it's a very sort of weird mispricing. These things trade. You see people on TV talking about in these podcasts pushing XYZ, like mid cap or large cap oil stock, oil services stock. These companies often have high single digit or low double digit free cash flow yields, very low growth. These services companies, especially some of the off the run ones that I've written about, have very robust double digit free cash flow yields. That they're using to pay off debt, buy back stock, buy assets at a large discount. I mean, it's pretty remarkable. I think the cheapest one that I own has a forward free cash flow yield on consensus numbers of something like 30%. And then a bunch of them are in the 20s in terms of free cash flow yield at current rates where utilization is going up and day rates are going up. So, I mean, I don't know. I don't know that I've ever seen anything quite as mispriced as this combination. It actually sort of reminds me of the upstream companies during COVID, except that the problem was that during COVID, the upstream companies were losing money, but they were cheap on replacement costs and cheap on likely future cash flow. The services companies right now, they're cheap on cash flow and EBITDA and sort of the conventional value metrics, but they're also cheap on replacement cost and some of the other deep value metrics. And so it's a very weird cheap on price to book, at least the more compelling ones that I own, I've written about, and so on. So pretty excited about their forward prospects. Pretty interested in how these stocks have traded. The market's almost trying to price in a decline in rigs, but you can actually see them increasing, and you can see longer contract tenor and some of the other indications. I wrote something recently on Canada booming and some of the beneficiaries of that boom, both from the upstream and services side, and for oil drilling and oil activity. Not the broader Canadian economy is troubled, but actually that contributes to that boom because when we got down to $70 oil, $65 oil recently in Canada, in Canadian dollars, it was still almost $100 a barrel. And some crude grades, I think, actually were still above $100 a barrel Canadian. And some of the costs are global, but a lot of the costs for these companies, domestic onshore producers in Canada, are actually Canadian dollar denominated. They're paying their people in Canadian dollars. They're paying for housing and some of the other things denominated in Canadian dollars. Yeah, there's been inflation, but they're still denominated in Canadian dollars. So as the Canadian dollar falls, it's actually, they become more profitable and they get to sell their oil essentially denominated in US dollars, and they get to pay many, if not most of their costs denominated in Canadian dollars. So that's like a big driver of the well economics, which is a big driver of the drilling boom that we're seeing in Canada. And then in the US, as shale productivity declines on a per foot basis, the companies are needing to drill more feet in order to keep their production flat, essentially, or to meet their very low production growth guidance. A lot of the companies, by the way, are going and buying small assets to try to meet their numbers because they're struggling so much to meet them. They've also drawn down their drilled uncompleted well inventories substantially. So they're going to need to drill a lot more. It's part of why they're drilling a lot more. It's also partly why there hasn't been a supply response yet from drilling more. I think, one, there's usually a delay, but two, we might not yet, even with the rig count up something like 50 oil rigs from the low point early this year, um, we may actually still not be at a break-even level to keep production flat here in the US. So especially if Bab el-Mandab is closed for some time and the Strait of Hormuz remains mostly closed for some time, and if the Houthis are going to close Bab el-Mandab and Iran is closing the Strait of Hormuz mostly, I wouldn't be surprised. And again, like they clearly have thought about this. They've done it before. I wouldn't be surprised if Fujairah comes under risk too. There have been tankers near there that have been attacked, and that matters because that's been sort of the third big off ramp for Persian Gulf oil, is to sort of the UAE has this bypass pipeline both for oil and also for gas. So they've been shipping some, I think, LNG off there. Um, and then definitely they've been shipping a couple million barrels a day of oil out from Fujairah. And that's at risk as well, because again, they haven't necessarily publicly threatened it, but they've attacked tankers near it recently. And they were attacking it. And also some Omani ports, which were an off ramp for some Persian Gulf oil. They attacked those in April too. I'm not sure that that seems the least likely to me of these in a potential escalation, but Bab al-Mandab does look like it may be closed. And again, if they're really trying to get oil higher, the strategy, as I understand it, and as geopolitical experts and so on have stated, is that if they can force oil high enough, Trump and his administration are so averse to high oil prices, then they may capitulate. Um, and or escalate. And it's sort of unclear which the IRGC wants more, given their sort of philosophical and publicly stated preferences. Um, so we'll see which direction the Trump administration goes, but it does seem like the play from the IRGC perspective is to push oil higher. And the way they accomplish that is one, through closing the Strait of Hormuz, which they mostly have, and then through closing Bab al-Mandab, which it looks like they are doing right now, at least to Saudi oil, which is the bulk of the oil that comes through. And so net effectively closing it and substantially reducing potential oil flows from the west coast of Saudi Arabia, which would dramatically reduce the Persian Gulf or Arabian Gulf oil flows to the broader market. This should call for radically higher prices. I already think the fair value for oil is probably around 110 or so WTI, just based on comparative inventory analysis, which was sort of the consensus way that oil was priced for fair value in the market by commodity analysts for a few decades. And so this time is probably not different. And so the conventional mechanism for pricing oil probably should stand. And then, there's always been deviations from it, but it's usually been both directions and not usually for this long. So you should already, I think, have $100+ WTI just based on the fundamentals. And then, I think with this supply risk and potentially enhanced fundamentals to the extent that the strait remains closed, production stays off, or more production turns off in response to it, you could see prices go up, and then you could see some geopolitical risk get priced in. We're not seeing it right now. So there's like, oil analysts and famous consultants and so on publicly complaining about this and asking about it and not sure about it. I can't fully explain it. I just think my suggestion was to drink some coffee. Wall Street Journal says that coffee is very good for you, even up to 5 cups a day, which is very interesting. And then have some patience. I think, excuse me, to the extent that the geopolitical analysts are right, and that the IRGC's strategy is to force oil up in order to force either escalation or capitulation by Trump, and by the US, then I would expect higher prices, especially if oil flows fall dramatically. Also, some of the geopolitical analysts have started talking about this. This was always my view. I don't think that China can hold off on oil imports forever. And it is noteworthy that some China-linked analysts, or sort of what do they call it, China-philic, like the people that like the Chinese model, or sort of further to the left economically and politically, have this idea that they're sort of perpetuating that China doesn't need oil, doesn't use as much anymore. And these calls are very, very similar to the calls in 2020 by similar, and in some cases the same analysts, pundits, etc., saying that oil demand is going away and that we won't need any more oil and that we've hit peak demand. They're making some of the same or very similar or analogous arguments um, as they're making then. And it just doesn't hold up. You look at the mobility data, you look at the fleet of cars and trucks and so on in China, and then you look at their resumption of substantial stimulus, which we saw pretty recently, and the aggressive stimulus very recently. And even though I'm very bearish on the Chinese economic system, communism fails, centrally planned economies fail. They fail gloriously when they are implemented in the way that China is arranged. And one of the best examples of this is the Japanese sort of boom and then very, very long bleed out on mercantilism and central planning, but to a way lesser extent than China and with way less of an extreme, they had a big property bubble too, but way less extreme dependence in their economy on construction. Um, I think there's a lot of risk to the Chinese economy, but they still have a lot of ability to stimulate it. And they've been very export oriented as they go and stimulate their services sector in their economy, which they're doing now. There is room for more economic growth in the short to medium term ahead of an inevitable sort of collapse, restructuring, or very long term, very painful bleed out over a decade or more, similar to what we saw in Japan. And so, um, it's not that I'm endorsing the Chinese economic system. I'm not. It's asinine. It's the same thing that's failed over and over again in so many different countries and over so long time. That being said, these things don't fail overnight. They fail, what as they say, slowly and then all at once. And in the meantime, China's probably still using at least 14 million barrels a day of crude oil, potentially 17 or 18 million barrels a day of crude oil. And so what that means is that eventually they're going to run out of their storage. They weirdly, for a while, were actually not using their surface storage. They were using underground caverns. This, I think, contributes to a theory that I posited publicly a year and a half ago about China maybe not actually having as much storage in their above ground storage. It is odd that they wouldn't have been using their above ground storage. Maybe it's because they have so much in storage they could use their caverns first and then above ground. But using caverns is actually more costly and more risky, where you could have issues like people have talked about a lot with the U.S. Strategic Petroleum Reserve, where as you draw that down, you can end up with degradation. They're not really meant for reuse over and over again. Um, so the question is, hey, why wouldn't they be using their above ground storage? And I would posit, well, what if they never had as much oil in their above ground storage as they claimed, or maybe they didn't even claim it. Maybe just the satellite data providers have claimed. And my historical reference for this would be the American Express salad oil scandal, which was actually the prelude to Warren Buffett owning a meaningful portion of American Express, which was one of his best investments ever in terms of dollars earned and returns and sort of this multi-decade hold and so on. Um, and so in that scandal, American Express had bonded salad oil tanks, which it turned out were predominantly water, and the proprietor had been cheating and essentially filling it mostly with water and then a little salad oil. And so, and it took years for them to figure this out, and they only figured it out. I can't remember what it was that triggered it. Maybe there was like a whistleblower or something, but the same mechanism could work quite easily for the Chinese storage tanks. And they had a big incentive, which was by showing more storage and claiming less demand, they could reduce their cost for imports, especially at a time where China's been in this multi-year downturn. Um, Freeing up hard currency to use for other purchases and to stimulate the domestic economy is in line with their sort of political motivations and frankly with their commercial practices. And so there are some questions here in terms of how much oil China has in storage. Maybe they have more, which is, I think, the consensus theory now, or maybe they have less and they've just been trying to suppress price. And my best guess is that the central planners and essentially communists in China are copying the central planners in Europe. And if you look at European natural gas storage levels, they are ultra low. And so why are they ultra low? Because at least in the European case, they tell you, which is they said that they were waiting, and various analysts and political whatever, they don't like formally tell you. So there's not like one statement from the EU saying, hey, we like told everyone to not refill for this reason. But when you look through the various sort of associated parties, they're a little more transparent than, even though they are also central planners, they're not as, they're more transparent still for now than the Chinese central planners are. And they say essentially that they were looking for a seasonal reduction in price before refilling their storage. The problem is they need a lot of gas to refill their storage, and China and other Eastern Asian countries uh, are now buying the LNG that Europe, I think, was counting on, and European gas prices are higher and Asian gas prices are higher, and they're nearing. They're not at the level, but they're headed back towards the levels that we saw a few months ago. So um, when I think about the Chinese oil situation, I can't help but think about this European natural gas situation. Europe is risking blackouts and people freezing to death to try to save a couple of dollars an MCF on the gas that they're importing, which is again sort of wild and also sort of like highlights why you don't want central planned economies. And, you know, individuals for the most part would not display this preference of risking freezing to death in exchange for saving a tiny amount of money. Generally, people will buy insurance, not sell insurance on themselves. So there's a giant insurance market because people have a preference of safety and stability. And especially, I mean, there's Generac and some of these other like home power companies. They do extremely well selling people essentially the equivalent protection um, from, you know, unreliable grids, but also just generally the ability to stay warm and safe in the winter and in the summer and warm places like Texas. And so um, I think when I think about what China is doing right now with oil, again, I think there's a lot likely in common with the European thought process on not refilling their gas storage. And what I think is going to happen, and China's done this historically a couple of times, I think they're going to panic and hit buy. And I thought they were going to go clear the market when oil got below 70. And they did start to import a little. They started to turn on their teapots a little bit for exports because refined product margins are so high. At this point, to the extent that the Strait of Hormuz stays closed mostly, and to the extent that Bab al-Mandab stays closed mostly, and the war continues or escalates, my expectation is there will be a moment where China just waves in all of the oil they can physically, and maybe ahead of that goes and buys a large amount of oil futures for staggered delivery, let's say, over the next year, 18 months or so. I am watching the forward curve for that. I would expect them to do that to the extent that they go for it. They may be waiting until closer to the US midterm elections to sort of get a 2-for-1. Again, I think they were expecting to be able to buy this oil for a lower price. And I think it's reasonably likely they will panic buy oil similarly to how the EU and these, European whatever countries are very likely to panic buy natural gas and LNG in the next month or two potentially because they really need to get with refilling their storage. Their storage is already too low, but they need to do in addition to that is also lock up additional cargoes for LNG for the winter, which is not 100% clear that they've done. And again, I think there's this price sensitivity, which is odd because they're really happy to go waste giant amounts of money on unreliable green subsidies and projects, which are failing, which is why they need all this gas and why it's such a problem that they don't have it. And so it's not really a money problem. Can they afford it? No, but they definitely can't afford the things they are spending their money on. And this is relatively small compared to those. And so I think it's both likely that Europe panics and imports a lot of LNG at a probably pretty high price in the next couple of months, and that China panics and goes and buys a bunch of oil in the, let's say, short to medium term. I don't exactly know, like it's not the same sort of time crunch as Europe for the winter, needing to refill storage ahead of the winter, but there's a risk of a similar sort of crunch, and maybe they have a few more months. But again, as I look at China, my expectation here, and no one knows, this is speculation and analysis, and my short term crystal ball is broken, and I may be wrong on this, but I would not be surprised if in the next couple of months, China weaves in a giant number of crude oil cargoes, turns back on their refined product exports in size, especially to support their friends and allies and suppliers of other commodities that they need to keep their economy running. Like, for example, making sure there's enough diesel in Australia for the various base metals that China imports to run their economy on and to be able to make sure they get enough coal. Ironically, they need diesel to be able to get coal. So I would expect China to ramp back up their refined product exports. I would expect them to wave in a whole bunch of crude oil cargoes, likely also position in the futures market to be able to get delivery of additional cargoes, or at least have price protection on being able to go buy additional cargoes. To the extent this continues, again, this is scenario analysis. There's no guarantees. This is not financial advice. I'm not soliciting you for anything. I am telling you about this newsletter that I write, which has done great so far. The ideas have done well. I published a very off the run oil market signal a couple of weeks ago calling for much higher oil prices soon. And I'm not normally like a short term price signal guy. That's not my normal thing, but there was something that happened that had only happened a few times in the last few decades. And every time it happened, we saw much higher oil prices over following few months. And so that happened, and it was not the Economist cover. I used that sort of as an illustration just because people were talking about it. The or that Economist article. The Economist has famously miscalled oil markets, as have many others, but they've also called them correctly sometimes. And so way less powerful signal, fun to talk about, sometimes right, but this was way, way, way higher hit rate, way rarer, and way more logical. So anyway, it hit, it was right. It's pretty cool to be able to call that. I can't guarantee that I'll be right on other similar stuff in the future. I'm a little amazed that it worked quite as quickly. I thought it might take a couple of months to really play out, but I'll take it. And so far, so good. And then um, let's see, any other notes before I close this up? I had run a bunch of sales and stuff on Bison Insights. I decided to sort of approach it differently, and at least at least for now, I'm just charging the posted price for it. If people want to uh, join, it's great. There's way over 1,000 people that are paying subscribers. I try to be responsive. And so what I noticed was that as I got over 1,000, especially as things heated up a few months ago, um, there was a big sort of demand on my time to answer individual questions and so on. And I like to do that. And so my response to that is to raise price essentially. And the simplest way to raise price is just stop running sales. So stopped running sales for now on Bison Insights. I'm actually looking into running a more premium product. So what I do on Bison Insights is I share relatively summarized key points on the oil market, on the natural gas market, and then on specific companies that I own stocks, that I own shares of, where I share an idea a month. In some months, I share two ideas, and most of them have outperformed versus the oil market and the broader market, but not all of them. And past performance may not be indicative. But what I do is I share the sort of key aspects, in my view, of the thesis, as well as key risks, and then give a little bit of a summary of what the business is and why I like it. Um, what I'm going to start doing, and I'm actually in the process of trying to hire a analyst or junior analyst to help me sort of build this out and do the modeling and help on some of the research and so on. I have one already, and he's over fully utilized. So this is going to be hiring a second. And the idea is to build out full financial models, something more similar to what the investment banks do, and then charge wild amounts of money to hedge funds and other sort of big firms for, and then being able to provide that not as investment research like investment banks do, but similar sort of base information and with a similar degree of rigor of analysis, as well as communication with the companies that are covered, and then providing that. I think the plan at the moment, and this is subject to revision, is to have essentially summaries and snapshots and so on of that available to the pro tier on Bison Insights, which is more expensive, but still, I think, in the affordable realm, and then potentially having a premium product for institutions and public energy companies and various other folks that have meaningful dollars at risk, or that really care about sort of getting full access, and for a price still likely at a big discount to what they think the investment banks charge for this, but at a more sort of price in line with what independent research providers charge for this, having that sort of full product available as a sort of professional product, likely off of Substack. But here on Substack, essentially continuing to run Bison Insights, not running sales on it, at least for a while. Um, and being able to continue to answer questions and do live streams sort of like this, but with sort of very active Q&A, walkthroughs of company presentations, um, various interesting perspectives, occasional commodity price calls, like I did a couple weeks ago. Had actually a pretty good run on commodity price calls, warned folks about oil geopolitical risk, pounded the table on Iran at a time where, I mean, people on social media and elsewhere were sort of very negative on my concern on Iran geopolitical risk and oil geopolitical risk, which I highlighted in January and reemphasized in February and pointed out some of the real risks around Iran and a potential supply disruption. So got that right, got the call to essentially flip from heavy on the natural gas side last year to heavy on the oil side this year, put out some stuff on this in December and January. Oil's turn in the commodity cycle, some data and analysis around that, got that right. And prior to that, got the natural gas call right, where gas was still not loved earlier in 2025. And there was sort of this mini cycle for gas where you went from, what was it, 3 or 250 or something, up to 5 with people super bullish. As people are super bullish, I pulled the pin, said, hey, this is not so interesting anymore. These equities are pricing in this tremendous story, but the fundamentals have actually shifted. It's time to focus on oil and oil stocks and not natural gas stocks. Did really well on that call. And my remaining natural gas positions actually did pretty well relative to the consensus natural gas names that I highlighted and compared against. Similar to that, there was one company that was on the run that some of the top Substacks and many investment banks and many pundits were really pushing, that I was really negative on. And so I highlighted the difference between that and my favorite idea in the natural gas space I think it was in 2025. Um, and then I think I did a refresh of that even earlier this year, just to highlight sort of the difference between those ideas and the varying performance. And the varying performance has continued there amazingly. My favorite idea on the gas side is still done really well. It's hard to buy, but it's very, very cheap still. Phenomenal results. And this one that people on TV were pushing, and famous analysts and people in the news and these top Substacks and other folks, they were all sort of pushing this thing. And it was very problematic. So my next article that I'm working on for Bison Insights is highlighting 3 Canadian oil companies that are on the run that people really like. And that, unlike this gas company, I actually don't think they're problematic. I just think they're fully priced and maybe overpriced for the excitement and the success they're achieving, the excitement that their investors are experiencing. And so I think that Clayton, you can actually look up which one this is. I'll send you, or I'll post in the chat a link to that article. And so there's a few of these companies that are just on the run. Everyone likes them. Everyone has buy reports on them, and everyone's so excited about their sort of success continuing to the future. These companies have high single-digit cash flow multiples on EBITDA to enterprise value, which is not cheap for E&P companies. And then each of them have their own specific challenges where they have had a lot of success, but maybe they don't have as much running room as people are saying, or as the market is pricing. Again, excellent businesses, just, and in some cases, I've actually owned them just at much lower prices, made money on them, sold them, and redeployed the capital. And then there's one company that I've written about that's very similar to them in many specific ways, or actually in key specific ways, where I think the market's not looking at this one, because people aren't talking about it, but 2, for very specific reasons that are mostly in the rearview mirror. And so I like these things. I like buying things that are hated very cheap as they're inflecting, I like buying them even more after they've inflected, where the stock has started to go up, but where they're still at a large discount to other very similar companies. And so I'm going to highlight that. It's a company I've already written about on Bison Insights, already sort of provided updates on. But I think this particular framing is, I think, new and I think hopefully helpful in better explaining my investment process and thought process. And I don't share these things as investment recommendations. People can buy them, not buy them. They should consult their advisors and do their own diligence. The point of it is to help educate and inform. And this, I think, is going to be a helpful way, similar on the natural gas side, where there was this thing that people were pounding the table on saying, you have to own this, XYZ person's associated with it. Look at these big discoveries, look at these big wells, et cetera. And they were wrong. And that stock has done very poorly. In this case, there's a similar sort of cast of characters, some of the same, some different, pushing these things. They have these narratives around the people and narratives around the assets and the returns and the success. And in this case, it's not that these companies are bad. They're great. They're just, in my view, very fully priced. And there's this other great company that's improved a lot over the last few years and looks a lot like these other companies that people love, except it trades at like a quarter of the valuation to half the valuation, depending on the metric that you use. So, very interesting opportunity. Really excited to share this thought process and this framing. And, it's going to be published on Bison Insights in the next couple of days. Um, as always, again, this isn't meant as financial advice. Really appreciate you taking the time to check it out, and hope I hope that Al-Mandab does not close, because 250 WTI, that hat may end up having been a successful prediction, but there could be really severe humanitarian constraints and humanitarian issues associated with that. And then I also hope that the oil price starts to trade more in line with its fundamentals, because the longer it takes for oil prices to trade at least in line with their current comparative inventory prices, where you should see WTI a little over 100, the longer it takes for that, the less of a price signal the market gets. So again, I'll close on this. The reason central planning fails is because central planners are imperfect. They can't properly process price signals and broad information in a way that is optimal for sort of long-term capital and resource and labor allocation. And while markets also are imperfect, markets are much better at gathering and pricing hard to find information and expensive information and deploying capital and so on. And yes, there are bubbles and all kinds of other issues with markets, but between central economies and market economies win by a lot over the long run. They're much more robust and resilient, and they rebound much quicker to the extent that the government stays out of them and doesn't intervene. There's lots of arguments that the US is also not a market economy, or is a lot less of one than people think or want. That being said, it would be wonderful if there was a better and more accurate and reasonable price signal in oil in order to induce more drilling activity to better supply the market in line with depleted inventories, depleted strategic petroleum reserves, and elevated geopolitical risk. So that's sort of my thought. Oil should be already, in my view and my analysis, and please don't rely on this, but it should be over $100 right now. And I worry that we're getting to that sort of 250 WTI. The reason I had that hat was I thought that oil would go to all-time inflation adjusted highs at the end of this next cycle, as resources deplete and as exploration is needed, and as there's sort of a call on all of that to get to a cycle high, and maybe even past that, which has happened in every other sort of big oil cycle. This is different. This is much more similar to the sort of 1979 potential blow-off top for oil, where you saw oil prices up something like 10x or so from 1969 to 1979. And I think we're at risk of something similar here, to the extent that Bab el Mandab fully closes and stays closed. and to the extent that the Strait of Hormuz continues on the current path, which is effective closure. So with that, I'm going to close this up. Thank you very much for joining and look forward to catching you on the next one of these. Take care.